Have you ever looked at a stock chart and felt completely lost? You see lines going up and down. It feels like a secret language. What if I told you there is a way to understand this language? A way to see what the market is trying to tell you? This is where candlestick charts come in. They're like a storybook for traders. Each candle tells a small part of the story of a stock's price. For Indian traders, Dalal Street in Mumbai. Home-based investors across India. Understanding these charts can be a game changer. They help us see the fight between buyers and sellers. Imagine a tug of war. Buyers, the bulls. Sellers, the bears. Candlestick charts capture this battle. They show who's winning and who's losing in a specific period. This is incredibly powerful information. It helps you guess where the price might go next. For anyone trading in the Indian stock market, Reliance Industries, Tata Motors, this skill is essential. It's not just about numbers, it's about understanding market psychology. Think of it this way: stock prices don't move randomly. They move based on the emotions of millions of people. People feel greed when prices are rising. They feel fear when prices are falling. Candlesticks are a visual representation of these emotions. Long green candle, excitement and strong buying. Small red candle with long wicks, uncertainty and confusion. By learning to read these patterns, you are learning to read the mood of the market. This gives you an edge that many people simply don't have when they start their trading journey in India. So why is this especially important for us in India? The Indian stock market is vibrant, dynamic, very volatile. We have seen massive rallies and sharp falls. In such an environment, you need a reliable tool to navigate the ups and downs. Candlestick patterns have been used for centuries, and they work across all markets, including our own NSE and BSE. They provide clear visual clues about potential reversals and continuations in a trend. This guide is designed to teach you, step by step, how to master this art, using examples from stocks you know and follow. So, what exactly is a candlestick? It might sound strange, but it's a very simple and clever way to show price information. Each candle represents the price movement over a specific time. 1 minute, 1 hour, 1 day, 1 week. Every single candle tells you 4 important things about a stock's price during that time. Opening price, closing price, highest price, lowest price. We call these the open, high, low and close, OHLC. This is much more informative than a simple line chart that only shows the closing price. Let's break it down. The main rectangular part of the candle is called the real body. This body shows the difference between the opening and closing price. If the body is green or white, the closing price was higher than the opening. That's bullish. Buyers were in control. If the body is red or black, the closing price was lower than the opening. That's bearish. Sellers dominated the session. So, just by looking at the color of the candle, you get a quick idea of the market sentiment for that period. Then, you have the thin lines extending above and below the body. These are called wicks or shadows. The top wick shows the highest price the stock reached during that period. The bottom wick shows the lowest price it touched. These wicks are very important. They tell you about the price volatility and the extremes of the trading session. A long upper wick might suggest that buyers tried to push the price up, but sellers came in and pushed it back down. This shows selling pressure. Similarly, a long lower wick shows buying pressure. Now, why should you, as a beginner, care about all this? Because it makes trading simpler and more intuitive. Instead of just seeing a random line, you see a clear picture of the market's action. You can spot patterns that often repeat themselves. These patterns can give you clues about where the price might be headed next. For example, a certain type of candle appearing at the bottom of a downtrend might signal that the price is about to reverse and go up. This knowledge can help you make better decisions about when to buy or sell a stock in the Indian market. In this essay, we will go on a journey together. We will start from the very basics and move towards more advanced concepts. My goal is to make you confident in reading candlestick charts. We will not just learn theory, we will use real charts from India. Infosys, HDFC Bank, State Bank of India. I will show exact dates and prices so you can see these patterns in the real world. This practical approach builds your skills. First, we dive into the anatomy of a single candlestick. We'll explore single candle patterns: hammer, hanging man, shooting star, doji. Each pattern tells a story about market indecision or a potential change in direction. I'll explain what they look like and what they mean for a trader. You'll learn to spot them and understand the psychology behind them. Next, we move to multiple candle patterns. 2 candles example, 3 candles example, multi-candle examples. These often give stronger signals than single candles. Bullish engulfing, bearish engulfing, morning star, evening star. We'll use recent Indian market examples and break down each trade step by step. Finally, patterns alone aren't enough. I'll give practical trading tips for beginners, common mistakes new traders make, and how to avoid them. Don't rely on candlesticks alone. Moving averages, volume. By the end, you'll have a solid chart analysis framework. Let's get started. Let's start by looking closely at a single candlestick. Think of it as a building block. Once you understand one, you can understand them all. Every candlestick has 2 main parts: the real body, the wicks. The real body is the thick rectangular part. It is the most important part of the candle. It tells you the story of where the price started and where it ended within a specific time. This difference between the opening price and the closing price is what gives the body its height. A tall body means there was a big price move. A short body means the price didn't move much at all. It shows a quiet trading session. Imagine you are looking at the daily chart of a stock like Larsen & Toubro or L&T. The stock opens for trading at 9:15 a.m. at a certain price. It closes at 3:30 p.m. at another price. The real body of the daily candle for L&T captures this exact journey between the open and close. If the body is long, it tells you that either the buyers or bulls or the sellers or bears were firmly in control for that day. A short body, on the other hand, suggests a day of indecision, where neither the bulls nor the bears could gain a significant advantage over the other. This body is the core of our story. Now let's look at the thin lines that stick out from the top and bottom of the real body. These are called wicks, or sometimes shadows. They tell you about the extremes of the trading session. The line extending upwards from the body is the upper wick. The very top of this wick marks the highest price the stock reached during that time period. The line extending downwards from the body is the lower wick. The very bottom of this wick marks the lowest price the stock touched. These wicks are crucial because they reveal the battle that happened beyond the open and close prices. The length of these wicks tells a fascinating story. A long upper wick on a candle suggests that buyers tried to push the price much higher. They were optimistic. However, sellers stepped in with force and pushed the price back down before the session ended. This shows selling pressure. Conversely, a long lower wick indicates that sellers tried to drag the price down, but buyers came in strong and pushed the price back up. This shows buying pressure. Understanding the interplay between the body and the wicks is the first step to decoding the secret language of the market. The next piece of the puzzle is the color of the candlestick's body. The color gives you an instant visual clue about the market's direction. Traditionally, candles are either green, red. A green candle is a bullish candle. It forms when the closing price is higher than the opening price. Think of it like a green traffic light. It means go. It shows buyers, the bulls, were in control. They pushed the price up and held it there until the close. The longer the green body, the more powerful the buyers. Example: Ikiki Bank. It opens at Rs 1100. It closes at Rs 1120. Close is higher than open. The candle is green. That tells you it was a positive day for IKIK. Buyers were more aggressive than sellers. A series of strong green candles can signal a powerful uptrend. It's a simple, powerful visual cue to assess strength and sentiment without scanning long tables of numbers. On the other hand, a red candle is bearish. It forms when the close is lower than the open. Think of a red traffic light, stop, or caution. It shows sellers, the bears, won that session. They pushed the price down from the open. The longer the red body, the stronger the selling pressure. It's a sign of weakness and negative sentiment. A big red candle is a clear warning sellers are in command. Example, Wipro. It opens at R450. It closes at R440. Close below open, the candle is red. That shows sellers dominated the day. A string of red candles can signal a downtrend. Just glancing at colors gives you the market's mood. Green means strength, optimism. Red means weakness, pessimism. This color coding makes candlestick charts intuitive and easy for beginners.